I want to talk about another thing that I think I'm kind of touched on earlier, but I think is really important, which is why do moats matter? And why does high ROIC matter? And you and I have debated this so many times, but I think it's something that we can spend hours and hours and hours discussing. But uh, what are your thoughts on it? Why do you think higher returns on capital matter? Why do you think a moat matters?
Okay, well, the return on capital, the importance of that is very mechanical. If you have a return on capital which is equal to your WACC, you create no value.
Mm-hmm.
You just get investors will just get inflation. If you get a 20% return on capital, you can compound your returns at 20% because every pound you get, you are then getting every pound you invest, you are getting 20 pence back, which you can reinvest into the business, and thus it compounds. But let's step back. What is a return on capital composed of? Well, it's your margin and your asset turn. So it's not just how much you sell it for and how much profit you get at the end. It's how much do you have to invest in it in order to get there. The moat is what means you can keep that and what means you can keep that sustainably. So if you have a competitive market where there's pricing pressure and you're all competing, your margins get eroded, your return on capital gets eroded, and then you're just going to be making your WACC, and you're not going to create any excess value. You can only then make inflation. But competition may not come just in that form. It can come in the form of CapEx. If it costs more and more to build, I don't know, a data center, maybe.
For example.
Then whilst you might still get that good pricing, because you're having to spend more, you're not getting that return. You're not going to be able to reinvest it for growth. All you're going to get, again, is the nominal return of inflation. So the moat is what prevents that. Why can you earn above average returns, sustainably? What is it? Is it your network effect? Is it your scale that no one else can actually scale up? And if you can't, is it that you have a protected cost position? You have to look at these factors because they are going to directly impact on your return on capital, which is going to directly then impact on the value creation through compounding, through cash flow. Either having excess cash flow to return to shareholders or having excess cash flow that they can redeploy into the business and grow it further.
I think one of the great things about a company that has a higher return on capital is that you can have you have company A, company B with the exact same revenue growth rate, the exact same margin, but one has higher asset turns, so has higher return on capital. So they need to invest less in inventory or equipment or whatever it is that's driving it to achieve the same amount of growth. And what that means is that it releases that much free cash flow. And so even though the revenue and earnings may be growing at the same rate for company A and company B, what the higher ROIC gives company B is that excess cash that they can either pay as a dividend or buy back shares. And so it translates the return to the investors from again, assuming the multiple doesn't change, from the growth of net income to growth of earnings per share, which could be faster if they're buying back stock, or total return through dividends. So that gives you the extra juice that a company that doesn't have a higher return on capital can't have. But I think the key question for me that I always ask of any investment that we own or any company that we own is, where is the moat coming from? And I just find that if you do not understand why you're earning these returns on capital and why, like you said, I think the key word that you said there was like sustainably. Yes. Why is this going to persist for the next? Capitalism works. And so why isn't someone coming and competing with you and competing away these returns? If you cannot answer that question, you cannot own something. Because the only thing that is worse than owning a commoditized business is owning a company with a high ROIC that is becoming a commoditized business.
A commoditizing business.
Yeah. But that's why incremental returns on capital are so important.
Exactly.
It's one thing to observe, just using a formula, the current return on capital. But what is really, I think, our job as investors, really fundamentally, is putting a judgment on what is the incremental return on capital, because that's what really actually creates value, isn't it? Is the return on capital that's being deployed from today onwards in excess of the cost of capital.
Absolutely.
Maybe I could ask both of you, what is your favorite type of moat? And
I love all my kids the same.
I'll start whilst you think about it. I mean, I think the best moat is geographic. If you own a piece of land in Singapore, they almost cannot make any more. They are making a little bit. But there is nothing better than that. But I think my favorite one from an analytical point of view is what I call the moat of broken glass, where you have one great industry leader, the sort of Ashtead, that is making, that has a 20, 30% market share. And maybe they have a competitor like United Rentals, but everyone else in the market, is only able to make their cost of capital, and they're all small. And so any big competitor would have to crawl through a moat of broken glass, getting bigger, outcompeting these small people in order to get there, because you just cannot make money if you're so small.
Yeah. Well, I think which one I like to observe the most is network economics. I think it's just a beauty to watch. And we've obviously made a lot of money owning Visa and MasterCard over the years, so we're very thankful for that. But the one that I think is the most robust, in my opinion, is scale economies shared. And the most famous cases of them are obviously Costco's and so forth, and Walmart before that. And where basically you're the scale producer, you have the lowest cost, and the key here is not to be greedy and give back the savings to the consumer. So you just keep kind of reducing your costs, and reducing your prices, so no one can come and catch up with you. And one company that we've owned, well, really since 2003, I've owned is LabCorp. And it's that. So they're the lowest cost producer in a market, and it's just they've continuously reduced their prices, reduced their cost, gained scale, ended up just capturing market share, acquiring other competitors. No one can compete with you as you become this scale player. And there's a company that we own now, which is Johnson Service Group, which kind of has the same dynamic, but on a smaller scale. It's just once you start going down that, as long as you have a management team that really understands that, they're not too greedy and they keep the savings to themselves, I think just no one can catch up with you. What do you
completely.
think?
No, I completely agree. I think being the lowest cost producer is such an underestimated source of ROIC, a source of a moat, particularly if they share some of the economics as well. I actually think Johnson Service Group is a great example of both a moat of broken glass and also the lowest cost producer, because they have this network of vans and laundries where they can push a lot of volume of linens and so on through this network. And it would cost a huge amount of capital for anyone to come in. It just doesn't make sense really for a new entrant to enter that market. And that's, I think, a really nice example of both the moat of broken glass, but also sort of scale economic shared as well.